welcome to the RA podcast. This is your host, Seth Green. Today, I've got the good fortune to be joined by Nic DeAngelo of Saint Investment. Nic, thanks so much for joining us.
Seth, great to be here today. Really a big fan of your guys' show here, and it's good to hang out with you, man.
Likewise, with a name like Saint Investment, we got to start there. How'd you get into the business, and how'd Saint Investment come about, and why the name Saint?
Absolutely. Yeah. So my background is in the entrepreneurial space and the investment space pretty much from day one. So I've been doing this for a very long time. I started off in distressed assets. So I had the good fortune of working for some really high-end family offices and some really smart guys that taught me a lot of amazing things. We were buying distressed assets that were defined as distressed in a million different ways across different categories. We were fixing them up and we were releasing them or re-bringing them to market, etc. So because that was just such an early business model and one I still love today, Saint has basically, the name came from us taking things that were really messed up or had big issues and adding a lot of value and bringing them back to market for the marketplace to use them at a higher level. So I kind of like that. And today, where that came from is we buy a lot of mortgages. It allows us to, these are semi-distressed mortgages. It allows us to keep homeowners in the home. It allows us to cash out banks by buying their mortgages that might have minor or medium issues. And it allows us to offer a high return to investors. So Saint kind of checks all the boxes and makes us feel good about what we're doing.
That is awesome. So let's do it a little bit. Let's dive a little bit deeper. There was a lot to unpack there. Distressed assets. What type is mortgages the entire category that you're buying in now? If not, what are the rest? If so, either way, what types of mortgages are you buying?
Sure. So I'm a real estate dog. I'll say that. I'm a lifelong real estate investor. I'm a lifer in real estate. I always will be in real estate. I love the asset class. I love the sector. I'll put it that way. What we saw as the best opportunity in today's market, with a lot of fluctuations and ups and downs, we saw buying, semi-distressed mortgages as the best opportunity, not because there's a whole lot of distress, but because the opposite is that they're actually one or two phone calls or one or two movements away from being on track for maybe 30 years, right? If you look at the US mortgage market, we're the only place in the world that has about 98% fixed rate mortgages of the marketplace. So when the Federal Reserve changes rates up, down, side, whatever they do, that doesn't affect the vast majority of that market. So what we do is work with big banks and financial institutions. We connect with them and clean up their books by buying what mortgages are having issues on their books. And maybe a family that's been in their house for a decade missed a handful of payments during COVID. That's a very common story, right? Maybe they got furloughed or laid off. Maybe that's a rolling balance. We get to call these families and individuals and say, hey, we're not the bank that wants to foreclose on you. We want to keep you in the home, right? So let's create a plan of what that would look like to get you guys back on track here so that you can stay in your home. We average equity of about 39% for our borrowers. So they want to work with us. They want to stay in their homes. And for how we've structured our fund, it's a fixed income fund. We want long-term income for us and our investors. So it's really a win-win. So that's kind of how we analyze things from top to bottom. We buy pretty conservatively, but there is a degree of distress just with the fact that payments have been missed at some point. We're trying to keep them in the homes.
Okay, so you're saving the day, hence Saint. Do you get any pushback from, how much is in the pool of mortgages that you own on behalf of, yourself and your investors now? I would imagine it's a pretty decent size.
Yeah, we're over 500 mortgages today.
Okay, so do you get any pushback from people when you're calling, just out of my own curiosity, when you're calling them going, hey, we're buying your mortgage from the bank that's trying to foreclose on you and we're here to help? Or do they believe you? Do they get pushback because they've gotten calls from bankruptcy lawyers and all kinds of other crazy people?
Well, I can tell you the outliers, the crazy stories. I got a million of those, right? Dealing with 500 mortgages and really thousands and thousands of mortgages to land on our favorite 500 that we portfolio. I could tell you all kinds of crazy stories. Most commonly, though, if I was to tell you kind of like what we see the most often, we usually come bringing gifts and tidings, right? It's like, hey, I know how you've been getting those foreclosure letters. We now own that mortgage. Our goal is to drop your payment or to create this mortgage around what you can or can't do so that you can stay in your home. That usually frames the conversation pretty positively. Sure, we still get the, hey, go pound sand kind of responses or prove it kind of discussions. Those are situations that we don't prefer, but the goal is always to keep people in homes. We can definitely navigate through the foreclosure process. I started there on the other end of the spectrum, buying large scale commercial in the foreclosure space. So I'm extremely comfortable with that sector. But because we have an income fund, that is actually not the highest and best use of our strategy. The highest and best use is keeping people there. So most commonly, people are really interested to hear what we have to say, because we say, look, how much can you afford? What's your family's financial situation? How can we craft something that works best for you? And most people are smart enough to understand that we come to make their lives better. So the average is very positive.
Well, that's awesome. So you've been doing this a long time. Talk a little bit about, where are you buying mortgages from? And then are you, in essence, your own CDO, CMO, you're repooling and selling that package to investors? How does that work?
Yeah. So like I said, I've been in the distressed assets market for a long time. I started with a couple family offices and was classically trained. The difference was, and kind of the background of where Saint came from as an asset manager, I was the acquisitions guy for so long. I was the guy that was finding the assets, building the relationships, buying the assets, whether it was on the courthouse steps in a foreclosure situation directly from banks. So we woke up in an interesting situation one day. And the issue that we were having is we bought too many assets that were performing really well for our investors. So the partners that I had at that time said, we don't actually want to manage all of these great assets. So Nick, why don't you build out an asset management team around this? So that was the genesis of Saint Investment Group. So if you fast forward to today, we have a lot of high net worth, clients and partners and investors, and they just weren't looking for the normal syndications that we did in the past. We did, 20 something syndications, great returns there. But the issue was they wanted something more flexible. So we went back to the drawing board to see what assets we had a lot of experience with that could give them that flexibility. I mean, you look at the market today, we have the we had the great resignation previously. Now we have the great retirement, right? We have all kinds of questions if the Federal Reserve is going to raise rates, lower rates, all that. There's so many question marks that directly affect the marketplace today that what our high net worth clients wanted was stability, something where they had a fixed return on an ongoing basis. So what we leaned into was the mortgage rates for kind of what I said earlier, was just the ridiculous amount of stability and the high returns that we could generate. So on our side, we are partnered or purchased the notes personally, the mortgages personally on every purchase. We work directly with many big banks, big institutions. We've worked with some of the biggest, big names out there that most people would know. Most of these transactions are relationship based, because the mortgage market is this weird thing where real estate, you and I could go on CoStar, buy something right now, right? You stroke a check, you show proof of funds, you make an offer, you navigate through a normal real estate process and you can buy that. That's not the mortgage market. It's much more behind the scenes, relationship based. So we've been able to navigate and kind of enter that space over the last decade or so. And now we kind of went full force and kind of started bringing in, opening it up to the public and retail investors more.
That's awesome. Let's talk about that. You've had quite a successful history. Talk a little bit about the exits, the AUM, and the amount distributed to investors.
Oh, yeah. So my favorites, right? Investors winning, my favorite storyline. So we started off really in we were buying just assets that we had the biggest returns on. So we were buying oftentimes at 50% of market value, things like that. What we realized was that we weren't buying economics. We weren't basing our purchases on economics. We were basing them off of market value percentage. That was a mistake, and we still returned great to investors. We've never lost investors' money, but we shifted over the course of our 20-something deals. I think the total number was 27 total deals that we've done. We still are in a dozen of them. We've been full cycle on, whatever the remainder, about 10 or so. Our average IRR has been 35.5% return to investors. So very high, with the understanding that we are aggressive buyers, with the understanding that, it's a timing play. So when when we say we have a deal, you got to pretty much move pretty quickly. Right. But We've moved almost entirely on the syndication side to industrial historically because it was such a critical asset class in U.S. Economy from there. But really, the shift has been now to providing that fixed income strategy that we're doing now. But our background, great returns there, but we just found a bigger upside with kind of the fixed returns, which now we're focusing on the 12 to 14% range on the fixed income. So still very high by today's standards of the fixed income world, and it's 100% real estate backed. So, I love equities. There's some great things about equities, but our clients are usually looking for an alternative to equities. If you look at the equities market since 1996, the number of companies publicly traded has been reduced by over 40%, a huge pullback in total number of companies that participate in different stock markets, different markets. So a lot of those dollars have gone to real estate funds and private equity. And we like that trend because, we're on the other side of it.
That makes a lot of sense. And you've got one heck of a track record. How you brought it up. We're in a very interesting interest rate environment. How has that affected you guys?
Oh, we love it. We love it. We love it. So real estate had a lot of things to sort through. I love multifamily as a concept and as a privileged asset class because the government props it up so significantly, right? And there's so many great, credit options and loan options available. But a lot of the real estate market needed a shakeout and it needed to readjust. So by many metrics, last year, 2023, was the worst year. It was actually worse for multifamily than it was in 2008. So in 2008, plus or minus, I think the reduction of values in multifamily is about 29%. Last year, I think it averaged in mini markets more north of 35% reductions. So while I love that asset class, it's a good case study to show that real estate is really readjusting in so many different ways. So today, I think it's finding what the winners are and figuring out, it's like don't fight the Fed was the moniker for so long, right? We went into this year, Seth, and I know you know this with your sophistication, with Wall Street calculating in 6 rate reductions for 2024, right? The most recent discussions are we're lucky to see 2. That's what I'm seeing, in the market. I'm looking to some of the big names. I'm looking to the BlackRocks. I'm looking to the Howard Marks. I'm looking to the Rick Readers, right? I'm looking to some of the biggest names in finance. I want to see what their bets are doing on top of Saints bets. And what I see consistently is a longer, stickier inflation cycle that we're in the middle of that I don't think the Fed has fully stamped out right now. I don't think it's going to go run away, right? I think we still see strong numbers and see strong economic data from the US, but I don't see inflation being as under control as some of the recent headlines in the last handful of months. So as rates go up or rates go down, our goal is to have an asset class that was not as impacted, right? The syndication world, if rates go up, things have to readjust. You're now fighting with every seller. The discrepancy of seller buyers has never been higher. Sellers think it's worth the moon, buyers think it's worth dirt, right? And so because that's such a difficult place to be in, we've sidestepped that. We've really went for kind of the older or more stabilized demographic that has a stabilized net worth that's just looking for stability. And so that's what we've leaned on because rates don't really affect our portfolio as much, candidly.
Well, that's a good thing. So how do you work with individual investors, or do they have to be accredited? How do those rules work? And then how do you work with registered investment advisory firms like our audience?
Absolutely. So we work directly with RIAs on a number of different ways. If there's people that are interested or want to be in touch, we have a bunch of different options. And then we work with accredited investors only, which is how we work on our side. We're a 506 Charlie, a 506C. Part of that's just because we market heavily and we put out a lot of content. So it double covers our bases that if we talk about what we're doing, we don't want that to be misconstrued as, a 506B conflict, right? So we're a 506C offering. It's accredited investors only. We love working with RIAs. And because we have kind of a fixed income model, we're making a lot of friends in the RIA space right now with what we're doing. And as soon as they feel comfortable with the higher returns, we have long-term partnerships that really take off.
Awesome. That sounds incredible. For our folks watching and listening that do want to learn more, where is the best place for them to go to learn about all things Nic and Saint Investment?
Absolutely. We only offer one thing that is a paid option, and that is our income fund. So they could check it out at saintinvestment.com. For investors, we also offer a ton of free education at saintinvestment.com/resources. But our fund is really, it's what we focus on day in and day out.
Awesome. Well, we greatly appreciate your time. We know it's incredibly valuable. This has been Seth Green with Nic DeAngelo from Saint Investment. Nic, thanks again for joining us.
Seth, it's been a lot of fun, man. Always great catching up with you.
Likewise, thanks everybody for watching or listening. We'll talk to you or see you next time.